Welcome back. Welcome back to another jobs report. Yes, we have a big jobs report today. One that could be the first that actually proves to the Fed that their rate hikes are finally working. We are seeing that in company earnings, companies projecting more of a slowdown going into Q4. A lot of concerns that GDP is now plummeting relative to the extreme GDP levels that we saw in Q3. Everybody thought the Atlanta Fed real GDP now sheets were a complete joke. Yet now, when we look at the real Fed now GDP, we look at wow, they were actually exactly correct about what GDP ended up being in Q3. Around 4.9% is what we got, and they were projecting between the upper fours and lower fives. And everybody thought this was crazy. Problem now, though, is even though they were right in the last quarter, we don't know if they'll be right going forward. But what we do know is that their estimates have dropped down to just 1.2% for the current snapshot of the economy based on the data we're getting right now. Today's jobs report will be a contributor to what GDP potentially ends up at. Today, we have the unemployment rate expected to hold steady at 3.8, looking for average hourly earnings to pop 0.3%. That's about 3.6% annualized. We want that to be closer to about 3%. And that is up from 0.2% last time. Year over year, we're looking for 4%. And the change in non-farm payrolls is expected to be 180,000. 2 days ago, we did get the ADP jobs report. ADP jobs report reported about 89,000 jobs. Last time we got a low print from the ADP report, we ended up getting a big beat on the BLS jobs report, the BLS, or some people like to say the BS jobs report. A lot of this has to do with the fact that people on Twitter like to take the jobs report and then talk about particular unseasonally adjusted changes. Like, for example, last month, somebody was complaining on Twitter that it seems like the government hired a lot of people, specifically teachers, and that our economy can't just be sustained by hiring teachers. And I'm like, bro, you're talking about September, the September jobs report. Duh, we hire a lot of teachers in September. It's back to school. So sometimes the depth we can find is not as deep as quite we need to go. We like going deep, and we like big PB, big pricing power. All right, so let's see what we got. Jobs report coming out right now. Here we go. Again, we're looking for 180. We got 150. A little bit weaker. There it is. Unemployment rate goes up to 3.9%. There it is. Uh-oh. This is like the first miss we've seen in a while. This is the lowest unemployment rate I've seen in a hot minute here. We are at a change in non-farm payrolls of 150. We've got the 2-month net revision negative 101,000. So we're lowering what we had last month. Instead of 336,000, we're coming down to 297. Private payrolls at 99, change in manufacturing employment down 35,000. That makes a lot of sense when you look at the manufacturers just getting destroyed by high interest rates. Unemployment rate 3.9%. We just got an uptick relative to that 3.8% we were expecting. Waiting for the report to load here. We're going to go through it in detail. Here we go. This is definitely weaker, though. This is going to be a problem. I would bet the Federal Reserve had a heads up on this data. Jay Powell is able, he said it before, so this isn't speculating. He said it before. He's able to get a heads up on this data. I think this jobs report is what led him to be dovish here, because this is definitely a below trend jobs report. 150,000. Unemployment rate going up. Here comes the damage. Manufacturing rolling over. Average hourly earnings do come in at 0.3%. That's, it's okay. It's not like super hot. We would have liked it to be closer to 0.2, but the survey did say 0.3%. We've actually got the NASDAQ rallying on this because, once again, it's a definition that, or it's a sign that the Federal Reserve is probably done here, that this is peak rates. Would not expect to, or would not be surprised to see rates falling. Yep, rates just dumped 9 basis points on the 10-year. That'll get even worse as people digest this. Employment declined in manufacturing due to strike activity. Okay, well, strike activity is one time, and that'll come to an end. So that could be actually an artificial low if it's just if it was substantially just strike activity. Job gains occurred in healthcare, government, social assistance. This, by the way, is late cycle. That is late cycle employment. That is very normal, though, to get that in the later portion of a cycle. However, that's because you get enterprises that say, "Okay, we're done hiring. Like we got to actually be cutting and be a little more efficient here." And then all of a sudden, people who need jobs can only get jobs potentially at the government because the government's hiring, whereas the private sector is not. This is actually a great opportunity for the government to finally get skilled labor again, new skilled labor. Unemployment rate for adult men, 3.7%, women 3.3, teenagers 13.2, blacks 5.8, Asians 3.1, Hispanics 4.8. We've got in October, the number of long-term unemployed was little changed at 1.3 million. Long-term unemployed accounted for 19.8% of all unemployed persons. Labor force participation rate little changed at 62.7%. That is slightly down, actually, from the 62.8% we saw in the last. Though we do get volatility on a month-to-month basis. Number of people not in the labor force was 5.4 million who currently want a job. Now, that's important because remember, JOLTS is 9.4. So you could go 9 or 9.5 rather. 9.5 divided by 5.4. That puts your available job to available worker ratio at about 1.76 for your JOLTS ratio, we'll call it. Among those not in the labor force who want a job, the number of persons marginally attached to the labor force a little changed to 1.4. Okay. Establishment data, we had 150,000 jobs. We'll want to see the households as well in a moment. Healthcare added at 58,000 jobs. We have government increasing by 51,000. It has now returned to its pre-pandemic level. Continued to trend up at hospitals, ambulatory care, nursing homes. In October, employment continued to trend up in local government. Social assistance jobs up 19,000. Construction, wow, look at that. Construction actually up 23,000, about in line. Manufacturing reflected a 33,000 job decline due to strike activity. Now, keep this in mind. You'd basically be flat if it weren't for the strikes. Flat in manu without strikes. Also makes sense. Companies just want to survive this high interest rate period. So as you survive, you just want to kind of flatten out if you can, if you've got your consistent labor. Oh, I forgot to change back to this right here, but it doesn't matter. You get to see the stick go up. In October, employment in leisure and hospitality, little change, 19,000. That's surprising. Yeah, that industry has averaged 52,000 jobs over the past 12 months. We only got 19,000 here. This is reminiscent of what we're seeing with an Airbnb slowdown, a Marriott slowdown. Very narrow payroll gains is what this is being called by the suits. Labor force participation rates first declined since October of 2022. Participation first declined since October 22. That's 1 year. First decline in a year. Employment in professional and business services, little change in October, 15K. Transportation warehousing, little change, -12. IT, -9. Industry has lost 44,000 jobs since May. That's the motion pictures industry. Average hourly earnings rose by 0.2%. Wait, hold on a second. Oh, here we go. Average hourly earnings have increased. Okay, wait. Private payrolls, 0.2% in October. Wait, but this said 0.3%. And then here it says, in October, average hourly earnings of private sector production rose by 0.3%. Okay. Well, I guess that's the one apparently people care about because that's the one we forecast for. Anywho. All right. Well, that is interesting. So then we get average hourly work week edged down 0.1 hours here. Well, I remember when there was a period of time that hourly work week was actually substantially higher just coming out of COVID. There were so few people working that you had to have everybody working substantially more. All right, household data. pull up the household data so we can compare this as well. Remember how this works, and this is an important distinction. So I'll touch on that. Also, before I explain how that works, also remember Noobers Pro crash courses. We are increasing the prices next Friday, November 10th. So stay tuned, November 10th for the next price increase. Employment situation. Okay, here we go. And if you have any questions about bundling up with some of the existing courses we have for the new Noobers Pro ones, email us at staff@meetkevin.com. Otherwise, check out the bundles available at meetkevin.com. Civilian non-institutional labor force. Here we go. So what do we have? This is how many people are in the labor force. We are looking for employed at 161.2 million. Okay. And how does that change from, whoa, look at the household survey. Holy crap, folks. Negative 348,000 household jobs. Holy smokers. Okay, so how this works. Household, they call homes. So the surveyors will call homes and say, hey, do you have a job? And they're like, yeah, I got a job. Or they're like, nah, I don't got a job. Okay. Then there's the payroll survey where the companies will call individual, or the surveyors will call individual businesses and say, yo, how many employees you got? And they're like, yo, I got 5, whatever it is, right? Payrolls is call biz double counting. Okay. Why is that a problem? Well, it could possibly inflate multi-jobbers, right? It just makes people get counted multiple times. The fact that the household survey just dropped 348,000 jobs is cray-cray. Wow. Change from September to October, negative 348,000. I mean, this has been, slow growing, but it's been growing. See, last year we were at 158,000. We've got 3 million more jobs since then. In August, we were at 161.4. Then we went to 161.5. Now we're at 161.2. That's a big boy number right there. That's really indicating some actual pain is starting to happen in the labor report here. I would actually be pretty concerned if I were JPOW and I saw if I saw that kind of household data. Oh boy, it is no bueno. Okay, payroll revisions knock 101,000 off. Touched on that. Treasury yields extend their decline. No duh. It was bullcrap. They ran as high as they did. They're down 10 bips right now. Looking at I wouldn't be surprised if we're getting more of an inversion right now with this sort of data. And we're inverting by an additional about 2 basis points. Looks like we've got, this is a bond-friendly number. Well, yeah, no, I'm concerned about that number here. Negative 348,000. Smallest payroll gains since June, where there was a dip. And the question is this a dip again, or will this sustain? Will this slowdown continue? Will it blend? I don't know. Taking a peek at how El Marquette is doing. Yeah, this is good for markets. There's a question here in the chat. Cultural Palace is wondering, is this good for markets? The answer is yes, because the market is a very perverse place that is very difficult to understand and takes substantial patience. The market wants the Federal Reserve's rate hikes to end and wants bond yields down. And when you get weak data, bond yields go down and the Fed is less likely to raise rates. That is literally what you were getting with this report. The Federal Reserve is saying, okay, we've gone a little too far, potentially. Yeah. The peak Federal Reserve rate right now is sitting at 5.35, which is actually lower than where we sit right now at 5.375. This is going to, in my opinion, plummet the odds of another hike at all. I think we're done. Labor is starting to turn over. A negative 348,000 jobs report on the household survey is horrible. It's very bad. And it does reiterate what the Atlanta FedNow real GDP estimate is showing about GDP actually starting to roll over. This somewhat explains Jerome Powell's flip-flop where he's like, well, when we say we want the economy to roll over, we want it to roll over, or we just want it to be below potential growth. Yeah, Jay Powell, you're about to get that. You're about to get below potential growth. So you're starting to see some of the interest rate stocks move. Bitcoin actually down about 1.6% on this. Looking at the pre-market here, you've got, look at that. Block up 17%. Redfin up 6%. I think MP Materials reported as well. Let's take a quick peek at them. MP, they're only up 0.4. I guess that beats being down. You're looking at Apple here, negative 1.5. Tesla up about 1.4. Much more volatile than an Apple, though. Matterport sitting at basically $2 even, and 2% there on Affirm. We'll see how markets move in the morning here. Bill.com got smoked yesterday. EXPI, that doesn't surprise me, down 8% on EXPI. Bill.com missed by 5% in forecasts and gave up about 30% of their market cap. Insane. So, okay, let's see here. The 10 basis point drop in 5-year yields tells you the rates market is still short and not enough people own duration. 100% in my opinion. 100% true. 100% true. Not enough people own bonds. That's duration. Remember, Bill Ackman flipped. Now he's long bonds, so he says. I think the guy's a great manipulator. So I take everything he does with a grain of salt because it's Bill first. But then again, can you blame that in a capitalistic environment? Anyway, this is I think when people wake up and realize, like, I still haven't seen the suits talk about this household number, but this is the kind of stuff where you're going to get a Kathy Wood come out, and a Kathy Wood's going to say, holy crap, household data negative 348,000. The Fed's gone too far. It is time to cut. Whoo, boy. Somebody here says Jerome Powell's doing cartwheels. I don't know about that. I think Jerome Powell might be like, oh boy, did we just go too far? Oh, how funny. Right after I said it, when is Wall Street going to wake up and realize the decline in the household survey? View a really massive decline in the employment and household survey, negative 348,000. Yikes. Anyway, all right. So there's our jobs report for today. It's not a great number. Not great. So that household's data can be volatile, but we'll pay attention to it. So stay tuned. Buckle up. Should be good for stocks. In the meantime, watch those bond yields. Everything is about bond yields. Whether you want to buy real estate, whether you want to buy stocks or hold the stocks you have, it's all about those 10-year bond yields. Oil up about 87.66 on Brent. Gold sitting at 2006. All indices clearly positive at the moment. And we'll see how the day evolves, given that this should be the nail in the coffin that says to the Fed, you are done. Done, done, done. Thank you so much for being here, folks. We'll see you in the next one. Really appreciate you. Make sure to check out those Noob vs. Pro courses in the links down below, or just go to meetkevin.com. Remember that this video is just perspective. It is not personalized financial nor real estate advice, even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker. It's not tax, legal, or otherwise personalized advice tailored to you. You know what we need is like the outro music going. Let's see, can we do that? Oh yeah, we can. Look at that. Any third-party content I show is shall not be deemed endorsed by me. This video shall not be deemed reasonably sufficient information for the purpose of evaluating a security or investment. And I personally operate an actively managed ETF and hold long positions in some of the various different securities I've mentioned. Thanks so much for being here. Not associated with a market maker either. Bye. Appreciate y'all.